Let me move to Brian. You are the CEO of Black Rhino, certainly a relatively new kid in the block in terms of Black Rhino, but you've been doing projects in Africa for many, many years. Why don't you give us your perspective of some of the challenges that you're facing, Brian, in developing your project? And you may use examples of actually live project if you wish.
Thank you, Alan. Yeah, I think development is difficult. I think we all understand that and see enough familiar faces around to know we say similar things. But often in development, because it does span different election cycles or it does span different economic cycles, you have certain risks that come up during the development timeline that weren't a risk 6 months ago. I think the issue of convertibility and access to dollars has become a hot topic with our shareholders, and it was something we weren't even thinking about 6 months ago. And when we get into these negotiations and you have some of the classic allocations of risk, to bring something new into it, it can almost be unfair to the governments from their perspective, because there's sort of a offsetting and horse trading of different key issues. And then you bring something in like convertibility. I mean, the worst thing for us would be to build a great project that we think is fully secure, but you couldn't take your investment out or take it home as you will. So we often find ourselves thinking about where we want to be from a investment perspective, based on sort of understandings of what the foreign exchange or convertibility issues could be. My office and team is located in Johannesburg, but to date we haven't been able to do anything in South Africa because as a dollar investor we haven't been able to manage the rand risk. We're heavily involved in Nigeria, Senegal, and Ethiopia. And the Francophone countries, which weren't as interesting to us before, are now becoming more interesting because of the peg to the euro. And you're seeing these shifts happen that really have nothing to do with the essence of a single project in and of itself. But overall, I think for us, success, whether it's from us or from another developer, is typically the key that we look for to go and try and replicate it. The project finance model is not rocket science, but it is complex. And the idea of being able to replicate the success of Azura is very attractive to us. We get to maybe go in on some of their pains and shorten our timeline a little bit, but the capacity sitting in Nigeria is certainly very strong on the back of Azura, and there's intellectual property there that can be replicated. That's very attractive to us, and it's certainly a market of size. So we know there's multiple projects that need to be done. In other countries where you have success, Senegal, I think the IFC project is a terrific success, and we're seeing PPAs we like. But it's not the same as Nigeria. It doesn't need 10,000 megawatts tomorrow. So in a way, there's a line there, and you have to understand where your project is in line. I think also, we are very curious and spending a lot of time exploring fuel sources. There's just been a huge push into renewables, and in some cases, almost naively so. For instance, in Djibouti, there's a huge desire to do renewable, but there's no base load to build on the back of the renewable program. So we need to first build probably HFO before we can build the renewables to actually have a grid system that's stable. You can't have intermittent power be driving the whole grid. So we're starting to think a lot about that. Minister Fashola in Nigeria just made a speech on energy, I think, over the weekend, and it spoke a lot about, what fuel for what part of the country. To say everything's going to be gas isn't realistic. To say everything's going to be hydro or renewable isn't realistic. So, how do you look at the southeast and south-south? How do you look at the west? How do you look at the north? And therefore, how do you look at sort of your approach here? Is it viable to be doing gas in Abuja, or should we be looking at coal in Abuja? Coal's not something that all the DFIs like to talk about, but there are DFIs who will do coal, and maybe things need to be looked at from that perspective. So we spend a lot of time assessing how we approach these different projects, and it has to be in partnership with the government because it has to work. It has to work from both sides. But then on the back of that, we assess it on how quick can we allocate those buckets of risk. If I can go in and I know something worked in a country and I can go in and replicate that, that's attractive to me. If I have to go in and be the pioneer and explain project finance, it's not as attractive to us, you know, and we've made that mistake before, and we're recalibrating our allocation of development risk money. You know, maybe say one last thing. You know, we really, as a company, when we look at those dollars you spend before a PPA is signed, you know, that's pure risk money to us. And we try to state a pretty strict disciplines on what ratio of pure risk money we would spend versus what investable money there is. You know, so if I have a $300 million investment, you know, I still want to stay in sort of a 20 to $1 ratio of pure risk money to those dollars. So the smaller projects become even more difficult because you have a smaller amount of money to invest, and therefore you have a smaller amount of money you can actually spend at risk to get the PPA done. So those are a lot of the things we think about. I'll stop there.
Okay, thank you, Brian. Lots of things to chew on. I particularly like the fact that as a dollar-based investors, you basically make those decisions to shift from countries to countries based on your perception or actually the reality of the risk on foreign currency is actually a big issue, and certainly your shareholders at Blackstone, they're probably making sure that you focus on those kind of risk.
Doing business in Africa, you can't afford to be without Africa Investor.